Good morning, ladies and gentlemen. Thank you for joining our webinar this morning. Well, actually, this is our first webinar this year, so regional webinar, at least regional webinar this year. So Happy New Year. I hope 2022 will be a good one for you. Well, we have the presentation, the webinar today that is titled The New Economic Reality. Indeed, after those 2 years of the pandemic, it seems that we have the new economic reality that we have to use to that. With still lots of consequences from the pandemic, not only related to the health situation, which right now, due to the Omicron variant, due to the pandemic, is still quite challenging, or is rather again challenging, but also coming from the consequences of that what we have had in last 2 years. Before I will start talking about the presentation, showing you our outlook, our view on the economy, just a few technical issues. First of all, you are please feel free to ask questions if you have during the presentation or afterwards. At the end of our meeting today, we will do the Q&A session, but nevertheless, if you have any questions already now during the time I will be speaking, during the time I will be showing you slides, please feel free to ask those questions. If you would like to do it, on the right hand side panel of this tool that we use today is the questions window. So then you can type your questions, and as I said, I will do my best to answer them at the end of our meeting. Also, if you will find interesting this presentation, or you would like to share it with your colleagues at your companies, you can download that immediately on your computer, to your computer. Also on the right hand side, there's a in this tool there's a handout section where you have where I uploaded the presentation, so you can immediately have it on your desk as well. Okay, so that's all from those housekeeping issues. Let's go to the economy and to the consequences of the pandemic that we have right now. Well, we have recently updated our GDP growth forecasts. So this is, if you attended our webinars in the past, that those are two charts I usually show, but I think they are changing more and more frequently, so it's still worth to take a look at them. Our latest forecast assumes that this year, 2022, we'll have the global GDP growth reaching 4.1%, and actually, compared to that what we had roughly 2 months ago, and that's a lower value that we estimated previously, because previously we expected 4.4%, and we see that okay, the recovery is going on, but it somehow has lost the momentum. Why is that? Of course, I will refer to reasons in a minute. I already said about the challenging pandemic situation that again reminded us that the pandemic is not over, but nevertheless there are also other issues that impacted our growth forecast. In terms of the split between advanced economies and emerging ones, well, roughly it's half to half, but compared to that what we had previously, it seems that emerging economies are those ones which suffer more from this losing the momentum more than advanced economies, at least what we see right now. Of course, our GDP growth forecast will be subject to several revisions this year. I'm sure of it, depending on the inflow of further indicators. But as of now, as you can see, for the largest economies, you have them on the right-hand side. We expect roughly solid growth rates in bulk of them, also including such important economies for us in Central and Eastern Europe, so like Germany, France, Italy, overall Western European economies. Finally, because for them 2022 of course was the year of recession, then 2021 was the year of the recovery, but not very fast recovery. Putting for a minute aside just Western Europe, so the most important trading destination for us, will have a strong growth coming again from China, from India, so big emerging markets. In the US, not as strong growth as last year, because last year it was significantly supported by household consumption, by fiscal stimulus effect, but right now this effect is fading out, and the growth will be still solid, but not as high as it was in 2021. So I've started to talk about Western Europe, and I think even not only in the case of Western Europe, but the global economy, we right now, after those 2 years of the pandemic, we see that actually it was a kind of three-stage recovery. So first we had China, and that was the economy that already recovered in 2020, where most of other regions at that time fought with the pandemic as the new issue, and also very strict lockdowns at that time. But China was the first one to suffer from COVID-19, but also the first one to recover. As you can see on the chart on the left-hand side, with nominal GDP levels of selected countries, and comparison to the last quarter of 2019. So here I mean the pre-crisis level. We have some countries that are above this 100 level, so it means that this pre-crisis level has been already reached, but others unfortunately not. So as I said, China was the first one to recover from this pandemic doldrums, and it still is going well. It's going above this 100 points line, but as you can see, the latest quarters are almost flat. Actually, we do not see the acceleration of growth, and indeed in China right now we see various constraints. We see that similar to the global economy, or even in a bigger extent, the momentum has been lost. Previously, the housing sector, residential property, this segment was contributing a lot the overall economy, but right now it's not as supportive as previously. Also, households, companies are less willing to spend, to invest, and as a result, we see that this line for last 2 quarters is nearly flat. Of course, in terms of other countries, I already told you about the US, and that indeed that was the country just next to China. It was the next one to recover from this pandemic deterioration thanks to fiscal stimulus. And then as the last stage, we have Western Europe, because here on this chart on the left-hand side, you have several Western European countries. Here, as you can see, last 2 quarters, were the period of indeed the acceleration, and unfortunately we have the latest data here for the 3rd quarter of last year. The updated data will be released at the end of this month, and then further figures will be released in February. But so far, unfortunately, we have only data for the 3rd quarter of 2021. And as you can see, there was an acceleration here. So also finally, Europe, the Western European region, joined other countries, big countries, with this recovery process. But also, as you can see, unfortunately, it's not back at pre-crisis levels. Of course, when we have in those few days, few weeks, released data for the last quarter of 2021, we will see finally a number of countries coming back to pre-crisis levels. But as of now, we see that especially countries that are dependent on the services sector, including the tourism sector, accommodation, hospitality, and so on, that was suffered a lot. Yeah, and here I think it comes with no surprise that we have Spain here, which of course is driven by the tourism sector, and then still and this recovery process is somehow slower than in other countries. And also that's a conclusion that we have in Central and Eastern Europe. And then you can see that on the chart on the right-hand side, that a bulk of countries in Central and Eastern Europe already recovered to pre-crisis levels, or it's quite high above them. It's not only the case of the third quarter, because already in the middle of last year, we had also a number of countries that were at pre-crisis levels. But here, those reasons I mentioned. So mostly a lower contribution coming from the tourism sector, from services, and different structures of those economies were the reasons why CE countries were able to recover faster than Western European countries. Of course, on this chart on the right-hand side, you can find Slovakia, you can find the Czech Republic, which are slower than other CE countries in the recovery process. That's on one hand because they are driven by the manufacturing sector, which right now suffers from supply constraints, but also, especially in the Czech Republic, roughly a year ago, we had very restrictive lockdown measures that still put some results on the pace of the economic recovery, because this it hurted the economic activity in that country. I've already told you that, and that you perfectly know it, that COVID-19 again is an important subject for not only the health situation, but also it's a concern for the economic activity. What we have globally, obviously, we have a surge of cases, a significant increase of COVID-19 cases due to the Omicron variant, but as epidemiologists say, it could be not the last one. We should be prepared also, unfortunately, for other variants. So still, COVID-19 seems to be not only as of now the important factor, but also it's going to stay with us for some time. And when looking just for countries in Central and Eastern Europe, so you have them on the right-hand side, with Germany as a comparison as one of the Western European countries. And that's quite a similar situation to the global trend in Central and Eastern Europe. Maybe the increase of cases is not as high as on the global scale, but nevertheless, as you can see, for all those countries, we have a significant increase of cases, and that's per 100,000 inhabitants. So concluding the number of population, that's why you can see that Russia is here. It has not recorded such a high increase like other countries, but nevertheless, compared to other waves of COVID-19, again, this is also a significant obstacle. Okay, and I said that COVID-19 is not the only one reason. So let's also take a look at reasons that still are constraints for the global economic activity, for the economic activity of particular countries. And those are those issues that we have right now regarding commodities, because prices of commodities, since their low levels at the beginning of the pandemic, well, they soared, they accelerated a lot. On the left-hand side, you have a few examples of natural gas, coal, oil, increasing a lot, especially two first ones, so natural gas and oil, natural gas and coal, sorry, and those were that increased a lot compared to the levels that we've seen at the beginning of 2020. And that is also the driver for other parts of economies, for other sectors. So if we have, for example, higher prices of natural gas, that also drives the cost of, for example, fertilizers, which as the cost of fertilizer is higher, that also is a driver for increase of prices of food, and we've already seen that the food price index increased in last quarters, last months. It's on relatively high levels compared to that what we had in the past. Also, if we would extend this chart on the right-hand side more, So going earlier than 2019, we would see that food prices are higher than we had in last years. Here on this chart on the left-hand side, we have quite an innocent, let's say, increase of oil prices, but again, as you see, it's an increase, yeah, and we see it also in case of prices of fuels. So the increase was not as high as in the case of natural gas, but nevertheless it increased, and this is the factor that also increases the overall cost, because if transports are charged higher, if they have higher costs, then they put also to the counterparties to final consumers, and that impacts the overall situation. And of course, right now the situation, because that was somehow, this is the past, this is the history. The question is that how long it's going to last? Should we be prepared to live with such high, for example, natural gas prices? And here our view is not, and our view is supported by forward contracts that, of course, especially in the European Union, also in Asia, we have high natural gas prices, but it seems that the peak has been reached. Of course, there are some geopolitical tensions here that also could impact this forward curve, but here we see that the toughest period will be right now, so the winter period, yeah, so January, February, and then perhaps also March, and then because we have really high demand for gas in winter periods of particular years, and after that usually the price of gas are going down, and we expect also the same, which again is supported by forward contracts, and that it should go down. But nevertheless, even in 2023, those prices will be on relatively high levels compared to that what we had, for example, since the start of 2015. There were some peaks during that time, but nevertheless, it's not that natural gas prices will go down, for example, to levels that we had during the first wave of the pandemic, where the high prices of commodities were really low. So not as high, but nevertheless, compared to last year's, staying at relatively elevated levels. And of course, energy prices are drivers for inflation. Again, that's not only one reason, but a significant reason here, that inflation is driven by higher energy prices. Well, here I just wanted to show you a few examples of advanced economies and emerging economies, and in both regions it's high. We do not see actually any exceptions. Right now, all countries, all regions suffer from much higher inflation. In advanced economies, it looks more terrifying, because compared to previous levels, we didn't have, as I said, in previous decades, such high levels. In emerging markets, as there were some currency exchange issues, twin deficits, so current account deficit, the budget deficit, and so on. So also some political risk, and then some emerging markets suffered from high inflation also in past years. But nevertheless, if we just compare that to last year's, for example, the years that we had before the pandemic, it seemed to be a good pace of economic activity, like 2017, 18, and 2019. Then inflation in all regions is much higher. I said about energy prices, I said about the pandemic issue that is still a concern for the economic activity. And right now, let's say a few words about supply chain disruptions. It's very crucial not only for the economic activity, but it is also another driver for the increase of prices. And here I put an example of the German economy, first because we are lucky to have some more detailed data on supply chain disruptions for Germany, but second It's of course for us, for Central and Eastern European economies, it's the main trading destination, export destination. So I think it's worth also to take a look at it. So, well, what you have here on the left-hand side, you have the chart coming from the survey with the share of companies that reported that the shortage of input goods are their main problem. So I think that that's important. The question was not if they see that if they have some shortages, but if they estimate, if they report that this is their main problem. And as you can see, there are lots of them, and actually this share increased in last quarters. It was already a concern, a difficulty in the middle of 2021, but then in next quarters, including the last quarter of last year, the share of companies reporting such shortage increased a lot. Mostly those are companies from sectors like electronics, like automotive, machinery, where this share of companies naming the input of goods, the shortage of input goods as the main problem is 90, 80 or even 90%. But also, as you can see in other sectors, they suffer a lot from that. And that's the reason why we see a different pace of the industrial production, manufacturing production, and new orders in manufacturing. So this is what I showed you on the chart on the right-hand side. So as we see that since these strict lockdowns, then there was a start, the beginning of the pandemic recovery. We also seen that in the manufacturing sector, and Germany, which is driven especially by exports and especially by the manufacturing sector, recorded increasing new orders. Yeah, new orders since roughly the middle of 2020 have been increasing, and compared to that what we had in January 2018, roughly since the first quarter of last year, we had them at higher levels than in January 2018. Yes, 2018. But as you can see, manufacturing production is lagging behind, is significantly lagging behind, and it's not that because demand is not there, but there are supply issues that cannot meet this increased demand. And I think right now it's a very significant concern, very significant issue, that those supply shortages, higher prices of inputs, they limit the recovery process. And here just one word more on Germany. This is the payment survey that we published roughly in the middle of last year. So that was the survey that was done in the first half of last year. First of all, on the left-hand side, you have average payment delays that are in Germany, and they decreased actually in Germany, and they decreased not only in Germany but also in other countries. Where we do surveys, we also see that insolvencies have been decreasing paradoxically. But that's the result of implementing various supportive measures that helped that the liquidity situation of companies have not deteriorated so much compared to the situation if we had just the impact of the pandemic with no supportive measures. So that's on the payment delays that I wanted to show you. But on the other hand, here talking about what I talked for last minutes, I also wanted to show you the chart on the right-hand side with views of companies on their main risk for the export business in the future. So as the Germany is export-driven economy, I think we could also conclude it as it is crucial for overall for the German business sector. And as you can see, as in 2020, the effects of COVID-19 on both world economy or the German economy were very significant ones, especially on the global economy. Right now, we see that German companies suffer mostly from the disruptions of the global production chains. That's again the confirmation, the chart that I showed you on the previous slide, that this recovery process in Germany is weakened by supply constraints. And You have that here on data with some numbers, but more or less it applies also to other economies. And as you can see, except of disruptions of the global production chains, we have the rising commodity prices, which are, as we said already, on high levels. This is the number two risk for German companies. So the question is that how long it's going to take. Well, and here again, two surveys with Germany and with another economy that is very important for the global economy, so the US. Let's start from the Germany. This is the survey that was done in October last year, and there companies expressed that they expect that those supply bottlenecks should be somehow less harmful or should terminate in 8 months. So then we would have the middle of 2022. But for some sectors like chemicals, automotive, they expect that the situation will last longer. And indeed, when we talk to companies from various sectors, including chemicals, automotive, they still see that this issue with supply constraints, with supply chain disruptions, will be the subject for 2022. So indeed, the second half of this year should be the period of some easing of that, but nevertheless, we will still remember that unfortunately supply constraints are the factors that are limiting the economic activity and the economic recovery. And more to that, the US companies, so that's what you have on the right hand side, they're, I think, less optimistic on that. They expect that even during the second half of 2022, those production and shipping delays will be still quite harmful. Starting 2023, and they see that there will be some easing of this constraint. As I was still quite negative on those challenges, I think there's at least one positive side in terms of this global mix of constraints, supply constraints. Those are maritime transport costs that finally have eased. Of course, they are very important as a significant part of trade between China and Europe, China and the US, and also other opposite directions is done via maritime transport. And as you probably know, we had the increase of oil prices that impacted also the cost of maritime transports. We have the availability of containers that decreased a lot, and we had also, of course, freight rates that increased in past months significantly. But as you can see from those two charts, both throughput index and freight rates, they decreased. But this is another conclusion, like I said about commodities. So it's the decrease, but to levels, not to very low levels, to levels that we had before the pandemic, or like with freight rates, those are the levels that are relatively high compared also last 10 years. So it's not that it's a significant easing, but fortunately, freight rates, maritime freight rates are not as high as they were in past months. And to somehow finish this global picture that obviously impacts our region, Central and Eastern Europe, I think that here the important factor for 2022 will be not only supply constraints, not only the pandemic issue, not only inflation, but also the monetary policy of big central banks, of large central banks. Of course, it's related to inflation because actions of central banks are driven by inflation levels. Well, here we have, it's likely that the US Fed will be the first one to increase interest rates. Also, we see that a part of monetary tightening started in the US, contrary to the Eurozone. The ECB is still quite reluctant to start kind of tightening monetary policy, even despite higher inflation. But staying with the US, This what's happening with it's what will happen with US interest rates and decision by the US Fed is also very important for other countries, because it will drive also some portfolio outflows or inflows. And here, as you can see, in case of emerging countries, there's a group of 36 emerging countries that the IIF publishes data for. When we had some issues related to the global situation, that resulted also in outflows of portfolio investments from emerging countries. And what we see right now, those countries which could suffer the most, which also the currencies could suffer a lot from the Fed tightening, are those countries rather outside Central and Eastern European region, especially those with high current account deficits. So these on countries on the right-hand side, you have countries like Kyrgyzstan, like Algeria, Tunisia, Laos, quite I would say exotic countries, but nevertheless still the external position is well, it could suffer due to such changes. And having said that, please remember that of course we Central and Eastern Europe are mostly subject to that what will the European Central Bank do, but nevertheless we are also somehow dependent on the global situation with the monetary policy, also with decisions of the US Fed. And here, if the process is strong, is fast, then it could also hurt currencies in Central and Eastern Europe, even if their current balance levels are not as high as those ones as you can see on the chart on the right-hand side. Okay, so finally we have our region, Central and Eastern Europe, and here I've seen that also we have today lots of attendees from Austria. That's why I included also Austria in several next charts, and that you can refer to your country. I mean, people coming from those countries. And well, those are our latest growth forecasts, but as I said, we will have several revisions of GDP growth forecasts. As of now, we see that the economic recovery is going on in Central and Eastern Europe. Mostly growth rates this year will be not as high as last year, because last year we had this so-called statistical base effect, so comparing to very weak levels of 2020. But as you can see, relatively solid growth rates from a number of economies, also including those ones like are driven by the tourism sector, like Croatia. Especially our estimate for last year is strong after the significant deterioration it recorded in 2022. What's important in our region? Of course, inflation. As in other regions, as in other countries, we had the increase of inflation. As you can see, it applies to all countries. In some, inflation is higher, in some lower, but nevertheless, it's elevated compared to 2022 and also beginning of 2021. And just focusing on inflation, on the latest inflation levels, so those one as of December 2021, so you can see them on the chart on the right hand side. Well, unfortunately, the highest inflation is in several Central and Eastern European countries. So those are Estonia and Lithuania. It's also the I would say it could be a conclusion that those countries are in the Eurozone area, but as they cannot increase interest rates on their own, that could also affect inflation. I do not mean that being a member of the Eurozone is something wrong, something bad, but nevertheless, other countries in our region have had this possibility to increase interest rates. But even despite so, we see that, for example, Poland is the next one with really high inflation. Here, in terms of inflation figures, except of just those typical reasons of higher energy prices, we also have another reasons, and one of those reasons, for example, for Poland and Hungary, is the weaker currencies of those countries. As you probably know, there are tensions between Poland and the European Commission, and also Hungarian European Commission, regarding the rule of law. That impacts also the availability of funds from the EU Recovery Fund for those countries. Still, there are some question marks if they will be available. In our baseline scenario, yes, it will be solved, but of course it impacts the view of investors on those countries, and that impacted also the currency exchange rates. As a result, the imports became more expensive, and that was another reason in those two countries that inflation was driven even more than in other CE countries. Talking about inflation, I think it's important also to look at the perspective of the labor market. Because, well, the labor market has not suffered a lot in our region from the pandemic. Of course, we had increase of unemployment rates, especially during the first wave of the pandemic, depending what tools, what supportive measures for the labor market countries implemented. But more or less, we see unemployment rates at somehow same levels that we had before the pandemic. Of course, talking about only unemployment rates would be not fair, because we have other indicators like employment dynamics, various other ones, looking more at furlough schemes that were introduced, but probably that would be the subject for just separate webinar. So just staying with the overall situation of the labor market. We've seen also that wage growth, it hasn't been hurt so much. So, okay, at the beginning of 2020, during, as I said, the first wave of the pandemic, there were countries which recorded the decrease of real wage growth, but then it came back again to solid levels. But as you can see on the chart on the right-hand side for these few examples of countries, right now we see that due to higher inflation, real wage growth is weaker than it used to be in past quarters, and also than it used to be before the pandemic. And even the nominal levels are still relatively high, so inflation is consuming a significant part of wage growth. And that puts us to a kind of price-wage spiral risk that could apply to our region this year. So I mean here that with increasing inflation, employees would demand higher wages because inflation is higher. If they get higher wages, then they will spend it for consumption, because our region is still driven significantly by household consumption, and that will be another driver for increases of prices for higher inflation, and then we would have this spiral. It's quite an important and dangerous risk. So far, it's not clear to say if we are at that point. It seems that not, but we have to be aware that such risk could be in 2022. So with those all other risks I mentioned on the global scale, in case of our region, we have to also remember about the risk of price-wage spiral. As I said, interest rates were increased in a number of countries in Central and Eastern Europe. The Russian central bank was the first one to increase interest rates. Then other central banks joined. The last one was the Polish central bank, which finally increased interest rates and already did it in several steps, and probably that's not all was said here, depending on inflation dynamics, not only in Poland but also in other countries. Interest rates could go higher. But here I wanted also to refer to, because as I said, inflation was driven by the energy prices, by those supply chain disruptions, so mostly by external factors that even if central banks, if they decided or if they would decide to increase interest rates, they would not impact significantly the increase of prices. But here on the right-hand side, you have the example of Poland and core inflation in Poland. And as you can see, okay, the inflation, the overall inflation increased a lot. It's especially the factor of energy prices, because this navy line is for inflation excluding food and energy prices. But nevertheless, even excluding those two volatile components, we have inflation much higher than it was in 2019, in 2020. And also, well, it's above 5% level, so it's relatively high. So, well, it seems that right now we have higher prices of services. We have also demand pressure that is driver for inflation. So indeed, that was actually the right time to increase interest rates by several central banks. And in case of Poland, it seems as they started to increase interest rates in October, that could be a little bit too late, because as you will see, core inflation actually started to increase evidently in the middle of last year. So perhaps the decision could be done earlier to right now we wouldn't have Poland so much on the right-hand side of this chart here. So with one of the highest inflation in the European Union. Okay, and also reasons for inflation and very important obstacle for companies is that's what's happening with inputs prices. Those input prices are much higher than inflation, so we see that companies do not transfer all of those costs for final consumers, for the clients, and we see that producer price indexes are higher in all countries. The highest increases, as you can see, are in Bulgaria, Romania recently, and the overall impact of not only higher prices of inputs but also the shortage of inputs is very important for a bulk of countries in our region. On the right-hand side chart, you have the example of the Czech Republic, and here's the survey with the factors limiting production. The statistical office asked companies what are the factors that limit production of industrial companies in the Czech Republic. And as you can see, this green line with insufficient demand started again to be very important at the beginning of the pandemic. So in the second quarter of 2020, indeed there were concerns regarding the demand with strict lockdowns. But then quite fast, when the economic recovery started, quite fast it ceased to be the number one factor. As you can see right now, it's not as much important. Labor shortages somehow came back in the Czech Republic and also in other countries, when we've seen that it became more important than insufficient demand. With this relatively good situation on the labor market, labor shortages became again an obstacle. But here, as you can see right now, the material shortage, so this input shortage, is much more important, not only than the concerns on insufficient demand, on labor shortages. Right now, nearly half of the surveyed companies reported that for them it's the most important factor limiting production. And as I said, as we expect that those disruptions will not disappear in few days, in few weeks, then we should also expect that this material shortage will be still quite harmful for companies industrial companies in Central and Eastern Europe. Well, here right now, just a view on also on external markets. First of all, on the left-hand side, you have the similar chart I showed you on Germany with new orders and industrial production. And Here, the trend is roughly similar to Germany. So new orders came in. There's a demand coming not only to Poland, but also to other countries in Central and Eastern Europe. But the industrial production level and those dynamics cannot meet the same line. So it's a huge gap between those two due to supply constraints. And that also limits the exports growth. So on the right-hand side, you have lots of countries, because here I included lots of countries from our region. But my point here was that we had a contraction of exports in the second quarter of 2020, but also the recovery was really fast, with exports going up, not only thanks to the improved situation on our main export markets, but also the global exports volume, for example, due to higher demand from China. We have lots of companies in Central and Eastern Europe that are included in various supply chains, and they benefited from that. But as you can see right now, we see that some of those lines are going down due again to supply issues, and those are especially countries dependent on the manufacturing sector, like Austria, Czech Republic, Slovakia, Hungary. Here, this momentum evident in terms of the export growth was lost. Of course, not only due to supply constraints, but as I said, pandemic issues with some concerns on demand, but supply issues are much more important here. On the other hand, we have countries, for example, here, especially Lithuania, is still going up, but please remember that Lithuania is driven also by the services exports, and here you have those lines for both goods and services exports, and with the higher with the increased digitalization of the Lithuanian economy, not only Lithuanian, but also other Baltics, with higher exports of such services, it also helped to be in this trend of improving for that country. And here one of the last things, last issues from my side from presentation. I showed you the German payment survey, but as I said, we also do payment service for another countries. In Central and Eastern Europe, so far we have that for Poland. And this is the survey that will be published shortly, should be published early next month, but I wanted to show you two important conclusions from the survey, from this latest Poland payment survey. One of them is regarding the average payment delays. Previously, talking about Germany, I told you that those supportive measures were the reasons why payment delays decreased in Germany. What was a kind of paradox that during the crisis we had decrease of payment delays, and also we had a decrease of insolvencies. But indeed, those measures were so supportive that it helped also the payment liquidity, and it made payment delays decreasing. That was actually also the case for Poland for 2020, that we had a decrease. But in the latest survey, and this survey was the replies were collected in November and December last year, we've seen that the situation has started to reverse actually. We see that average payment delays increased in 2021. This increase was, as you can see, by several days, by 9 days, almost 9 days as the average. But for a number of sectors, even increases were higher. Here right now, what we have with average payment delays in Poland, or rather we had in 2021, was the level we had in 2019, so before the crisis. So we are coming back not only with the economy to pre-crisis levels, with the nominal GDP levels, but also with the payment situation, and coming back to those levels, it means deterioration compared to 2020. And in terms of consequences, of course, we expect that it could have impact on insolvencies. We do not expect that insolvencies will accelerate significantly just in few months, But nevertheless, just not only talking about Poland, but also other countries, it seems that with unwinding those support measures, also insolvencies will not be as low as they were in 2020, but they will be gradually coming back to pre-crisis levels. So again, it means increasing. And also in Poland, we ask companies about their obstacles for the business activity, most important ones. And it's not like in Germany that those supply chains disruptions are the #1 constraint. However, just overall higher operating costs coming from increased energy prices, components, and supply chain disruptions were mentioned by quite a large number of companies. But here also, similar to Germany, COVID-19 is not anymore the most important obstacle. Is right now #2, and its impact on the Polish economy. #1 obstacle, there are taxes and other fiscal burdens. So I would say quite traditional but regular obstacle that previously, before the pandemic, companies suffered, and they reported that for them it's a significant obstacle. And as a last point, because we are running out of time, our latest revisions of country risk assessments that were done already several months ago, with the upgrades of a number of countries in Central and Eastern Europe, in Europe general, thanks to this economic recovery, thanks to coming back to pre-pandemic levels, not by all economies, but nevertheless, in case of Western European economies, being close to that. And actually, I think that's a good conclusion of our upgrades that we've done those few months ago, because we also came back with country risk assessments mostly to pre-crisis levels. So it's not that it's a significant acceleration. We see those constraints, those obstacles, but right now it was justified to come back with again back to the pre-crisis levels. Right now, please take a look, because we will issue the next barometer publication in the middle of next month, where we will have the revisions update of our country and sector risk assessments. Then we will have another countries revised. So if you are interested in that, please take a look at this barometer. And as I said, we also have sector risk assessments for 6 regions in the world, but also for particular countries. And the latest revisions for our region were for the retail sector and for the transport sector, again thanks to the economic recovery. But indeed, as I said, we see lots of challenges. So still we monitor those risks also in terms of the sectorial perspective. Well, so summing up, the economic recovery is going on, but it has lost momentum due to higher inflation, due to supply disruptions, and also due to pandemic concerns as a result of the increased COVID-19 cases and possible other mutations that also could be there and could impact the economic activity. Nevertheless, we expect solid growth rates for a number of economies, including Central and Eastern Europe. Well, so that's all from the presentation side. So as I said, please feel free to ask questions. Perhaps something was not clear when I was speaking for last almost 1 hour. So if you also have some questions on that, what I said, please use this opportunity. Also, if you'd like to share your views, I would be happy to read your comment. If you would like to share any of your comments, perhaps you disagree with some of what I said. Okay, I see that we have first questions coming in. Okay, the first one. Given slowing down of nominal GDP growth, I don't know if I started from the beginning. Yeah, it seems so. Given slowing down of nominal GDP growth, but what is the real GDP growth figures taking into account skyrocketing global inflation rates? Yes, that's actually a very good question, or rather even conclusion, because indeed we should indeed real GDP growth could be treated in different point of views right now, because it could be some effects could be excluded here, not only inflation but also and the statistical base effect. As I said, in 2020 we had a decrease of GDP growth, then in 2021 we had a huge increase, and right now we compared to this increase of 2021. So this real GDP actually right now it became a difficult term. So I think we should not be focused so much. I showed you GDP growth because it's that what economists focus on, but I think we should not be focused only on this indicator. We should be in such situation like we have right now with lots of challenges. We should focus also on other indicators, so like retail sales, industrial production, that in case of our region are going up, but retail sales are impacted by higher inflation. Industrial production is impacted by supply constraints. So indeed, and even those indicators are easier to observe because they are published on a monthly basis and they are published faster than quarterly GDP growth rates. Okay. There's a question, where would you put wholesale and distribution sector? I guess you mean in our sector risk assessments. I think so, yeah, that's what you mean. Well, basically, although that this part of retail it seems to be just dedicated to retail, we also include the wholesale and distribution here, because the English name indeed maybe is not very fortunately here. It could be like the trade sector, so indeed we could also put here the wholesale and distribution. However, in that case the situation would be very wide. And when we had reasons for upgrade of the typical retail sector, then could be another reasons for wholesale and distribution. So please do not treat those sector risk assessments that you have right now as the very detailed one, because in very detailed ones we go into more specifics on particular sectors. We go more also to company by company basis, because I believe right now it's even much more important, because we can have companies from one sector that are doing completely different. We can find companies from the ICT sector that benefited from the pandemic situation, but we also can find those ones which are on the verge of bankruptcy due to the exposition on some countries or some subsegments. So I wanted to show you those assessments, but if you are interested in more details, I think it's not the relevant tool. Okay, another questions. What do you see today as the biggest economic problem? Inflation, energy supply chains. When do you expect inflation to calm down, and at what level will it stop? I mentioned all those issues that you mentioned here. So inflation, energy supply chains, because indeed it's difficult to point one. Nevertheless, if I would point the most significant one, I think it's inflation, because we see, as I said, that supply chains disruptions and also somehow energy prices should not be as high and as harmful in next months or the second quarter of this year as they was previously. But as producers, manufacturers transfer those higher producer prices to final consumers gradually, also with some delay, I think that the inflation factor would be the last one to stabilize. Of course, that depends on, as I said, on the core inflation, on the components of inflation, and how much central banks could lower this impact. But as of now, as what we have right now, I think that the inflation will remain the most important subject for 2022. And I would expect that closer to the year end, perhaps then we will see that inflation is slowing down, but nevertheless it does not mean that is going significantly down. I mean here that it stops to accelerating. It's likely to to remain on higher levels than it was before the pandemic. Of course, we have countries in our region like Poland, like Hungary, that introduced some anti-inflationary measures with decreasing excise taxes, value-added taxes on particular goods, especially those ones which report the highest increases. In case of Hungary, it's the ban on some food prices. But here, especially in case of Poland, I would expect that, okay, on one hand, after the winter season, we should not have such a high natural gas prices, but nevertheless, if we have right now just temporary effect with the limitation with the decrease of value-added tax and also excise tax, then the problem comes back in next months, and especially if we have this ongoing economic recovery with household consumption going on. So it's more like it's postponing this problem. So in Poland, for example, I would expect that the inflation due to these anti-inflationary measures was moved away, but it does not. It didn't disappear. Yes, it hasn't disappeared. It will be also in 2023 in Poland. We are likely to have elevated inflation due to that fact. Another question. How long is expected that state will continue to support economy in CE countries, and what will happen when it will be fully stopped? Well, I believe that countries in our region, not only in our region, but also in other regions, are very careful with unwinding support measures. So first of all, as we know, budget deficit, fiscal deficits, they are extended. They extended a lot in 2020, and countries would like to have them down with not as high deficits. And that's why they are much more selective in the tools they provide for companies with the problems coming still again from the consequences of pandemic, from the overall situation. But nevertheless, I think that they are aware that the complete unwinding of those measures would be harmful, and that would be the trigger for really the surge of insolvencies. So that's why I expect that they will be very, very careful with that, but at the same time, it's difficult to answer precisely your question when they will be fully stopped. So is there any particular point of time? It depends on economies, on the structures, on their structures, on that how they are still impacted by the situation. Okay, let's take a look. Another question. Do you think the European Central Bank is going to raise interest rates? Well, I think at some point of time, yes, but right now, it's right now not. I do not think that it's going to do it this year. I think that it will be reversing its stimulus program, so it could be somehow treated as a tightening of monetary policy, but not increasing interest rates. I still believe that the US Fed is the first one compared to the ECB to start the process. Although I think that rhetorics here have changed a little bit because the ECB many times repeated that this increase of inflation is transitory, it's not permanent, but I think it started to change in case of the ECB decision makers. but I still believe it is afraid of dwarfing the economic activity with increasing interest rates. And the issue here is that we have really a large number of countries, and here let's be frank, let's be straightforward with that. Countries, those large countries like Germany, France, Italy, here the European Central Bank would care much more what are the inflation levels in those countries than in, for example, in Baltic countries, where right now in December we had higher inflation. Okay, how would you see European economic situation if inflation and COVID-related vaccines and COVID test production growth would be eliminated from GDP growth and export? Because I think that the part of this question was cut. Okay, now I can see the full question. How would you see European economic situation if inflation and COVID-related vaccines and COVID test production growth would be eliminated from GDP and exports growth data? Interesting question. You mean inflation and COVID-related growth? Then I think we should also exclude those supply chains issues because it's a part of driver for inflation. Well, I'm just thinking that it would be good to implement here some econometrical model for that. But I think at the same time, the question is that what would be left, because those are very important challenges, very important constraints. So at this stage, I cannot answer your question. It could be something that could be done by us, by economists, to see indeed what would be this level. But as of now, without any calculations, quite detailed calculations, I cannot answer this question. Okay, I see that I've answered the bulk of questions. We are behind the schedule, so I will not consume much more of your day. Well, I hope you found this webinar interesting. As I said, once again, if you would like to download the copy of the presentation, please do not hesitate to do it. It's in the handout section of this webinar tool. And well, I encourage you to attend our webinars in the future. We do it on a regular basis, and actually I've seen that lots of you, we have a regular attendees for our webinars, so it's really for us, well, it's very motivating that you are coming back to our webinars. So I hope to see you at our next webinars. So far, stay healthy, and thank you for joining the webinar, and I wish you a nice day. Thank you. Bye-bye.